In One Up on Wall Street, Peter Lynch offers valuable insights into the art of stock investing, aiming to empower individual investors with strategies that allow them to outperform professional fund managers. Lynch's approach is grounded in the idea that ordinary people, who are in tune with the products and services they use every day, have an edge over Wall Street experts. While institutional investors are often burdened by size and bureaucracy, individuals can take a more flexible, long-term approach and can invest in companies that they truly understand. Lynch firmly believes that successful investing doesn't require a finance degree or insider knowledge but instead relies on curiosity, common sense, and patience. Lynch's key argument is that individual investors can gain an advantage by focusing on businesses they encounter in their everyday lives. He calls this, investing in what you know. Rather than trying to outsmart the market with complex strategies or tips from analysts, Lynch advises observing the world around you for companies that are doing well and showing signs of growth. Whether it's a local restaurant with long lines, a new product that's catching on, or a service that's gaining popularity, these are often the early signs of a company on the rise. In fact, Lynch suggests that many great investment opportunities start with observing trends that haven't yet reached Wall Street's radar. The key is to see what others might overlook, and this can be as simple as paying attention to the businesses and products you are already familiar with. Throughout the book, Lynch discusses how the stock market often reacts irrationally to short-term events, creating opportunities for those who are willing to look beyond the daily noise. He emphasizes that short-term price movements, market analysts' opinions, and financial news can often mislead investors. By focusing on the fundamentals of a company, such as understanding the product or service it provides, its growth trajectory, and its financial health, investors can make better decisions. Lynch advises that, rather than trying to predict market movements or follow the crowd, investors should focus on the fundamentals and the long-term story of a company. One of the key components of Lynch's approach is categorizing stocks into 6 different types, each with its own investment strategy. These categories include slow growers, stalwarts, fast growers, cyclicals, turnarounds, and asset plays. Each category requires a different level of research and expectation. Slow growers are well-established companies with stable, but slow, growth rates. These companies are not likely to provide huge returns but are often dependable and suitable for conservative investors. Stalwarts, on the other hand, are large, established companies that grow slightly faster than the overall market. They offer a safer investment than fast growers but come with solid growth potential. Fast growers are small, younger companies with rapid earnings growth. These stocks are typically riskier but can deliver impressive returns for investors who are willing to take on the volatility. Cyclicals, such as automotive or steel companies, are sensitive to the economic cycle, meaning their stock prices rise and fall based on economic conditions. These types of stocks require careful attention to market cycles. Turnarounds are companies that have experienced difficulties but are undergoing significant restructuring, and they may present excellent opportunities for investors who can spot the early signs of recovery. Finally, asset plays are companies whose assets, such as real estate or patents, are undervalued by the market. Investors in these stocks are betting that the market will eventually recognize the true value of these hidden assets. Lynch encourages investors to focus on understanding the financial health of companies by looking at key indicators like revenue growth, earnings growth, and debt-to-equity ratios. He also advises investors to be cautious of companies that have too much debt or show signs of financial instability. By focusing on companies that are growing steadily, have manageable debt, and show strong cash flow, investors are more likely to make sound investments. Lynch highlights the importance of researching each company thoroughly to ensure it is financially stable and has a clear path to future growth. The book stresses the importance of long-term investing and advises against trying to time the market. Lynch firmly believes that the best way to make money in the stock market is by holding on to stocks for several years, allowing time for growth to compound. He criticizes the practice of constantly buying and selling stocks based on short-term market movements, noting that even professional fund managers struggle to predict short-term trends with any consistency. Instead, Lynch advocates for focusing on the fundamentals of the business and holding stocks long enough for them to realize their full growth potential. In his view, the key to successful investing is patience and a willingness to let compounding work its magic. One of the most compelling aspects of One Up on Wall Street is Lynch's focus on finding 10-baggers, or stocks that increase tenfold in value. These types of stocks are often smaller, less followed companies that have high growth potential. Lynch argues that while it's difficult to predict which companies will become 10-baggers, there are certain characteristics that these stocks tend to share. They often have strong earnings growth, a clear growth story, and an established competitive advantage. Lynch advises investors to look for these opportunities by paying attention to emerging industries or companies that are poised for rapid expansion. In addition to growth potential, Lynch emphasizes the importance of evaluating a stock's valuation. He advises investors to use metrics like the price-to-earnings (P/E) ratio and compare them to the company's earnings growth rate. A low P/E ratio relative to the company's growth potential can be a sign that the stock is undervalued and represents a good buying opportunity. Conversely, a high P/E ratio might indicate that the stock is overvalued, though there can be exceptions for fast-growing companies. Lynch also discusses common mistakes that investors make and how to avoid them. One of the biggest errors is falling in love with a stock and ignoring the warning signs when the company's fundamentals begin to deteriorate. Lynch advises that investors should always be willing to sell a stock if the reasons they initially invested in it are no longer valid. Another mistake is investing based on hot tips or rumors, rather than doing independent research. Lynch stresses that relying on tips from analysts, friends, or media reports is often a recipe for disaster. Additionally, he cautions against panic selling during market downturns. Stock prices are volatile, and emotional decisions based on short-term fluctuations can often lead to missed opportunities or poor returns. Lynch also highlights the importance of managing a portfolio effectively, particularly in terms of diversification. While diversification can help reduce risk, he warns against over-diversification, which can dilute returns and make it difficult to monitor the performance of each individual stock. Lynch advises that investors should aim to hold a manageable number of stocks, focusing on high-quality investments that they have thoroughly researched and understand. Finally, Lynch encourages investors to remain optimistic and view market volatility as a natural part of investing. He reminds readers that market downturns are inevitable, but the long-term trend of the stock market has historically been upward. He stresses that patient investors who stay the course through market fluctuations will ultimately be rewarded with strong returns. In conclusion, One Up on Wall Street is a practical and accessible guide to investing that encourages individual investors to trust their instincts, focus on what they know, and make informed decisions based on thorough research. Lynch emphasizes that anyone can be a successful investor by avoiding common mistakes, staying patient, and taking a long-term view. The key to success, he argues, is not following the crowd or trying to time the market but focusing on the fundamentals of the companies you invest in and holding them for the long haul.